Hey everyone, welcome back to Corporate Decoder, the place where we try to find the hidden treasures in what looks like a boring old pile of corporate documents. This month we're diving into SRx Health Solutions Inc. Its latest filing, and folks, let me tell you, it's a roller coaster ride with more twists and turns than a daytime soap opera. We've got a lot to unpack, from serious financial shifts to some truly mind-bending risks. Before we dig in, if you love getting these unfiltered insights from the real corporate world, hit that subscribe button. And remember, our Discord community is linked in the description below, where we break down even more financial drama and opportunities. Alright, so SRx Health Solutions Inc., a company that's been through quite a few name changes and restructuring efforts, is trying to get more shares out into the market. They're looking to sell up to over 101 million shares of their common stock, coming from a bunch of different investors and former owners. This is a huge number, representing about 51% of all their stock, if you count everything that could potentially be turned into a share. The big takeaway here is that a lot of people are looking to sell, and that can put a lot of pressure on the stock price. Now, they did a big merger back in April 2025, combining with a company called SRx Canada. SRx Canada is the main part of their business now, focusing on specialty pharmacies and clinics all across Canada. Think of it as a network that helps people get really expensive complex medicines for rare or chronic diseases. They've also got this pet health business through Halo Purely for Pets Inc., which they dividend out some of to their existing shareholders. Now, for the really juicy part, SRx Canada is in some serious trouble. They filed for creditor protection under something called CCAA in Canada. That basically means they're trying to restructure their debts and operations with court supervision to avoid going completely bankrupt. They've secured some debtor in possession financing, which is like a loan to help them stay afloat during this restructuring. This situation is definitely adding a lot of uncertainty to the company's future. Meanwhile, their US pet food business through Halo is also facing challenges with ongoing losses. Management is looking at all sorts of options for that business, including selling it off. Let's jump into the financials, because that's where the real story often is. If we look at their unaudited, condensed, consolidated balance sheets for June 2025, they've got about $12,000 in cash, which sounds like a lot, but when you look at their liabilities, especially current liabilities of over $74 million, it suddenly sounds like not enough. Their total shareholders deficit, a fancy way of saying they have more liabilities than assets, is a staggering $45.8 million. This right here is a flashing red warning sign about their financial health. When we check out the revenue for the 9 months ending the 30th of June 2025, it was about $41 million. That looks okay until you compare it to the same period in 2024, when it was over $117 million. That is a massive drop of 65%. They explain this as severe operational disruptions driven by a lack of money to buy and dispense crucial medications. Basically, they couldn't get the drugs to the patients, which directly hit their sales. Their operating expenses also saw a big jump, going up 34%. This all adds up to a huge operating loss of over $32 million for the first 9 months of 2025, compared to a smaller loss of about $8 million in the same period of 2024. Their net loss for the 9 months ended the 30th of June 2025 ballooned to almost $30 million, a huge increase from about $11 million in the prior year. It's clear the company is bleeding money, and that's a major concern. Looking at where the cash is coming from and going, we see that cash provided by investing activities was about $13 million for the 9 months ending June 2025. That sounds good, but it was mainly from selling assets and that cash from acquiring Better Choice during that merger. Meanwhile, cash used in operating activities was almost $16 million, meaning the core business is burning through cash very quickly. Their financing activities brought in about $3 million, but this is largely due to private placements and debt that needs to be paid back. You can really see the strain on their balance sheet. For instance, their current portion of long-term borrowings is a massive $24.8 million as of June 2025, and their total liabilities have shot up to almost $80 million, while their shareholders' deficit is sitting at negative $45.8 million. This picture is not pretty, and it's why the auditors flagged them as having substantial doubt about their ability to continue as a going concern. They are basically saying this company might not be around for much longer without significant help. Now, the company is looking to get more shares out there, and that's where the selling stockholders come in. They are basically allowed to sell a ton of shares into the market. The problem is, when you have so many shares potentially flooding the market, it can really drive down your stock price. It is like having way too much of something for sale. You have to lower the price to get rid of it all. This offering itself will not bring any money into the company, it's just letting existing investors sell their shares. The risk section is absolutely massive, and for good reason. They're talking about the company's ability to continue operating, the impact of cyber attacks, business interruptions, competition, and a whole lot more, including the fact that their debt could limit their flexibility. They also mentioned the possibility of their stock being considered a penny stock, which can make it harder to trade and less attractive to investors. Plus, their listing on the Nice American is hanging by a thread with them, needing to show they can meet listing requirements by November 2025 or face being delisted, which would be a huge blow. When we look at the selling stockholders and the shares they want to offer, it is a long list. These are the investors who are poised to potentially sell a huge chunk of the company. Given how many shares are being registered for resale, it's a strong signal that many of these investors might be looking to exit their positions. The offering itself, meaning the shares being sold by these existing stockholders, is pretty straightforward. They want to sell up to over 101 million shares. The important thing here is that the company itself isn't getting any money from these sales. They've got over 24 million shares outstanding right now, but if all the warrants and options were exercised and preferred stock converted, that number balloons to nearly 200 million shares. This means massive dilution for existing shareholders if all those shares hit the market. Looking at the leadership team, we see some board members changed in late 2025 with 2 directors resigning. Kent Cunningham remains as CEO and Carolina Martinez as CFO. But with the company in CCA proceedings and facing an uncertain future, it is the leadership's ability to navigate these very serious challenges that will define the company. Now, for my own take on all of this, SRx Health Solutions is in a very precarious position. Their Canadian specialty pharmacy business is facing a major restructuring due to financial distress, and that's casting a huge shadow over the entire company. Their US pet business isn't exactly a shining star either, with ongoing losses. The fact that their auditors are explicitly stating there is a substantial doubt about their ability to continue as a going concern is probably the most critical piece of information here. It means they are at high risk of not being able to meet their financial obligations. The drastic 65% drop in revenue is a direct consequence of their liquidity issues. They simply could not operate and serve their customers. This isn't a minor blip, this is a sign of severe operational breakdown. While they mention plans to raise capital and restructure, it is a long and difficult road ahead, especially with the current economic climate and their existing debt. The numbers on their balance sheet paint a picture of a company deeply in debt with very little in the way of assets compared to its liabilities. The shareholders' deficit is substantial and highlights the financial challenges they are facing. The risks outlined in the filing are not just theoretical, they are very real and directly tied to the company's current situation. So what is the verdict on SRx Health Solutions Inc.? Well, right now it's a company in active crisis mode. They have a lot of passionate people and some potentially valuable assets in their Canadian pharmacy network, but they are facing immense financial and operational headwinds. The CCAA filing is a serious indicator of trouble, and whether they can successfully restructure and find new capital is a massive question mark. For investors, this filing screams high risk. There is potential for a turnaround if management can pull off a miracle, but the odds are definitely not in their favor without significant financial restructuring and a strong injection of new money. It's a classic case of a company trying to navigate a very difficult storm. Alright, that is our deep dive into SRx Health Solutions, Incorporated's latest filing. What are your thoughts on their situation and the massive number of shares being registered for resale? Let me know in the comments below. If this breakdown gave you some clarity, smashing that like button really helps us out, and of course subscribe for more corporate reveals. And don't forget to join our Discord community linked in the description for more in-depth discussions and direct access to our team. Thanks for watching, and we'll see you in the next decode.